Welcome traders, it's Ian from CPP Trading. In this video I will share the 5 steps and formula I use to calculate the lot size for trading gold. I created this video to help you understand lot sizes and position sizing. I will show you how you can do this completely on your own without having to rely on a trade manager or lot size calculator. So watch this video as I walk you through the steps, pay attention and take notes. When we're trading Forex and CFDs, there are two main categories. The first one is Forex that are currency pairs, for example, the euro dollar, the British pound Japanese yen, and the US dollar Canadian dollar. The other one are commodities, and gold is a precious metal, so it falls under the category of a commodity, gold with the symbol XAU USD. So first we need to understand what a lot size is, specifically a standard lot. There's a difference between the currency pairs and commodities. So for the currency pairs, one lot is 100,000 of the base currency. For gold, one lot is 100 ounces, specifically a troy ounce, whereas one troy ounce is exactly 31.1034768 grams. You don't have to know this, but it doesn't hurt to know it. The 5 steps for calculating your lot size. First, we need to define your risk amount, like how much are you going to risk on that trade. Then we need to identify your entry point. That's based on a price level. Number 3 is we need to determine your stop loss. Again, what price level are you going to set your stop loss? After that, we have to calculate the price difference between your entry point and your stop loss. And lastly, we're going to use the formula to convert that into the lot size so you can open your trade. Okay, let's look at an example here. Say we have a support, the price has been ranging above, and now as the price is breaking below that support, we are looking to take a short. So we're looking to take an entry with a stop above the most recent high, and we're anticipating that the price will continue to move further down, where we're going to take profits. Entry at say 2407.8, and a stop is going to be at 2414. Let's move over to a chart. This is gold on the 30-minute time frame. Been in a uptrend, created a high, created a lower high, lower high, lower high, and another lower high. Whereas been sitting at a support around here with a few rejections, and now the previous candle has closed as a bearish candle. So we're looking to take a sell below at 2407.808, and we'll place a stop loss above the high of that candle at 2414. And we are anticipating that the price will continue to move down, where we are taking our profits. This is our profit level because previously this price level has been a resistance. So the price has been rejecting this price level and it then turned into a support. So with knowing that this has been a previous support, we have a very high probability that the price will retest that level. Let's take a look at the price difference. Like I said, it's the price difference between your entry and your stop. So with the entry at 2407.8 and the stop at 2414, we have a price difference of $6.92. Now let's look at how we are calculating your risk amount. So I had an account size of $100,000 and I am willing to risk 0.6% on any given trade. So 0.6% equals to $600. The way you get to that number is you take your account size and you times it by the percentage of your risk, how much you're willing to risk. The lot size. We already know that one standard lot equals to 100 ounces, troy ounces to be specific, and 1 ounce is 0.01 lot. You take 100 ounces divided by 1, and the risk per trade is $600. We are willing to risk 0.6% on any given trade. Now, if the trade size is 0.01 lot, our risk is $6.92. That's because it's the price difference between our entry and our stop based on just 1 ounce. Next step is we have to take our full risk 600 divided by 692 and we get 86.7. However, we have to round that to 86 ounces because we can only trade 1 ounce. We cannot trade 0.5 or 0.7 of an ounce. Here we get to the formula for calculating the lot size. First step is we have to take our risk, the risk amount, divided by the price difference per ounce and times that by 100. So for this example, the lot size formula is $600 risk divided by 692 times 100 equals to 0.867 of a lot, which we have to round down to 0.86 lot. And here is why. So for example, if we take the 0.867 rounded up to 0.87 lot, 692 times 87, because 87 ounces, we get 602 and 4 cents. So $602, it would actually exceed our risk of $600. That's why you always have to round down the lot size and never round it up, because if you're rounding it up, you're actually going to exceed your lot size, and depending on how much you're trading, it will be a small difference or a big difference. So let's review this trade. It was taken on gold, XAU USD, with a lot size of 0.86, made a $1,600 profit, which was very good considering our overall risk of $600. So the initial risk was at $595.12 to be specific, and we realized a profit of $1,601.32. We took the sell here at 2407.08. Price approached our target level and trade was closed. Our initial stop was placed at 2414, where we had a risk reward ratio of 2.6. So exactly it was 2.66, but an overall risk reward ratio of 2.6, which is very good. We have now discussed all 5 steps. We looked at an example, looked at the formula, and learned how we can calculate the lot size for trading gold. And I hope you liked this video. If you found it helpful, give it a thumbs up and subscribe for more content like this. And I'll see you in the next video. Trade safe.